Hi everyone, it's Mike from Order Flows and welcome to the Order Flow Dynamics course module number 10 on risk, money, and trade management. After all, it'd be impossible, I think, to put together a trading course and not talk about risk management, money management, and more importantly, trade management. Many traders think that money management is the key to success, right? Money management is important, but you must realize that no two trades are exactly alike. That is where a lot of traders run into trouble with money management. They're treating all trades the same. The problem is they're over-focused on the financial risk of the trade and stop thinking about what's happening in the market. In many cases, it gives traders a false sense of security as it's removing them from the market. People will say, well, my testing has shown that this is a 69.2% winning trade with a average profit of 3R and a loss of 1R. You're sort of removing yourself from the market, and losing traders tend to think in certainties. Right? Successful traders think in probabilities. When you have an edge, but you don't take the trades, your edge quickly disappears because you're trading your trading method, and the few trades you don't take can be the difference between success and failure. Now, the only true factor of trading that a trader has control over is the protective stop level. It's one of the most, if not the most important part of trading. Now, the profit potential of any trade can never be accurately defined. Profit potential is an expectation or hope. Now, you can define how much you want to lose on a trade, but you can never define profit potential. You can't go into a trade and say, I want to make X amount of money on this, because the market may not give you X, so you can't make it. However, you can risk X amount of money, and the market will be sure to take it away from you. So you can define your risk, right, by where you place your stop, but you can't always define your profit potential in the sense of you're guaranteed to get that profit potential. You just can't. Okay, it's impossible. So for example, right, this is the chart here. These are some nice shorting opportunities, some nice bearish points of control. You get short, and you're getting short around the 40-70 area, right? And you got to take profit around 40-50. It doesn't get there, right? There's no guarantee it's going to go there. And what happens? Market rallies back up, gives you another short opportunity, but you've already tried shorting it and it didn't go to your profit potential. So you got to understand, right? The market doesn't always go exactly to the point you want it to go. So you can define your risk. You can define, okay, I'm going to get short at 70. I've got to stop at 80. Okay, 10-point risk. And I'm going to try and get 20 points out of it down to 40-50. But if the market only goes down to 52, you're screwed, right? So trying to think in exactness is what's going to hurt you, right? If you realize, oh my gosh, you only got down to 52, market's starting to tick back up, comes back up to 65, then it comes right back down here, back down to 54, 55. You got to start thinking, can this market really get down to 50 or not? Should you be covering it here at 55 and be happy with 55 or even 60, right? Because the market is not giving you the 20 points. It's only giving you 15, maybe 10. Worst case, you're going to get break even. The stupidest case would be getting stopped out. So what's the difference between trade setups and a trading plan? Right? A lot of traders fail because they think having a trading setup to look for is all they need to be successful. No. A trade setup is just part of the overall trading plan. A trade setup allows you to take essentially the same trade over and over without much thinking. You still need to apply money management, risk management, and trade management. A trade setup is the starting point to build your trading plan around. And once you start building your trading plan, right, you have your trade setup. The trading plan is going to stop you from trading irrationally. It's going to stop you from not knowing where you're going to enter the market. It's going to stop you from being unprepared. It's going to stop you from overtrading, and it should stop you from blowing out your account. So for example, right, here's the MES. If you have your trading plan, whatever it is, say, I'm going to be buying stacked imbalances. Okay. You know where you're getting long. You know where you're going to be placing your stop. And you're only going to be focused on when you see a stacked buying imbalance or a stacked selling imbalance. Okay, so you know where you're going to enter the trade. You're not going to be unprepared. You're not going to take trades that you shouldn't take. And you're not going to blow out. Because you're going to be focused on what you should be focused in the market. Now, you have to think part of the trading plan is your exit strategy. Are you going to, you got to think about letting winners run. You got to think about cutting losers short. What's the reason for getting out, scaling out of trades? Did market conditions change? Are your stops based on market structure? Time stops for trades that are not paying you. And, do your stops have enough space for average rotations? All right, so let's take a look here. So this is a MES chart again. We've got, a reason for getting long down here. Right? We got a delta surge coming in, 217, 266, 913. We also have some indications in the points of control right in here. That's also a nice buying opportunity. So the first thing you got to think of, can I let my winners run? Trade is going in my favor. Can I get more out of it than my normal profit level? Okay. You're watching the order flow, it's going in your favor. All right. You don't have to think about cutting the trade short because it's going in your favor. Now you get up to this high up here around the 31.45 area. Is there any reason for getting out? Well, we still got positive delta. We're sort of going sideways in here. You understand that after a vertical move, the market is going to go horizontal. So if you're long, you can start scaling out of trades. That's the nice thing about trading micros is you can trade size that you normally probably wouldn't do in the E-minis unless you had a deep account. Okay, now are market conditions changing? Well, not really. Still got positive delta. We're just kind of drifting a little bit lower, but no strong selling, right? No bars with multiple selling imbalances. Okay, so your stop originally was down here. It was based on the market structure, the swing low down here. Okay, you probably can move it up to an area in the money, ideally somewhere where you start seeing the aggressive buying coming in. Okay, now you're in the trade from about 907, 908, maybe 910. And are you getting paid? You're at 920. Yeah, you're still getting paid. Okay, do your stops have enough space for a rotation? Okay, came up here, we're going to rotate down 3 or 4 points. If you moved your stop up, you're down somewhere down here on 36. Yeah, you can handle a 3 to 4 point rotation. So trade management mistakes that a lot of traders make is they have no clear exit strategy, right? They let losing trades get ugly. They take profits early. They get greedy. It's like having the good devil on one shoulder and the angel on the other. Take profits now. No, stay in the trade and get more out of it. Sometimes you place your stops too tight. Sometimes as the market starts getting close to your stop, you just, I get it. I'll just move it up, get out of this position. Or sometimes your stops are too far. Not getting out when it's time to get out. Using the same stop parameters for all markets and conditions. I've seen people do this, and it's frustrating because they'll use like the same stop that they would use on mini Dow that they're using on ES. I'm like, you can't do that, right? It's a different market in the sense of price movement. And the last one, letting stops take over your market analysis, right? Like, people, sometimes they choose arbitrary levels for their stops, rather than analyzing the market structure and where they should be placing their stops. Now, when deciding which trades to take, right? There's high probability trades, there's low probability trades. A low probability trade has a high probability of failing, right? One of the many reasons traders blow up accounts is they don't let go of a bad trade and it follows them into their next trade, either psychologically or, they're thinking, oh my gosh, I got to make it all back on this next trade. And then they end up taking a low probability trade. Those are the trades that most often fail. Now, you need a reason for every trade you take, right? A trap many traders fall into is taking a trade and it loses, then immediately take another trade, often without reason, looking to make it back immediately. Don't be that trader. Often you hear a trader say, I made a dumb mistake. That is often their dumb mistake, right? As silly as that sounds, don't make those things. Once in a while I get in that, it's a form almost of revenge trading where it's like, you had a nice trade going on and then you screwed it up somehow. Then you think, I'm better than this. I could take this trade, even though it's a low probability. It's a borderline trade. It doesn't fit into your trading plan. Then you just make matters worse. Don't do that. That's the dumb mistake. A high probability trade does not mean that you won't have losing trades. What it means is when you're wrong, the losses will be minimal, but the profit potential is big. Taking high probability trades requires patience, right? That's an important thing, is patience, and it requires a trader to not take unnecessary trades or risk. Understand that, if you have a trade set up, that your bread and butter trade set up, right? You sit there and you wait for it. Okay, if it comes, you take it. If you get stopped out, you get stopped out. You understand that that's going to happen on those trades, right? You don't get flustered and then start taking some flyer on the next trade, right? For me, a high probability trade is my ratio and divergence, right? On my software, it's the divergence and the ratio. Tells me get short, Mike. I get short, I get stopped out, fine. Okay, they don't work out all the time. Oftentimes they do work out and they give me nice profit. So in trade analysis, right, when you're in a trade, you must monitor it in order to maximize it. Is the trade working as planned or not? Is the trade moving towards the target? How close is it to the target? Is the trade moving towards the stop instead? How close are we to the stop? You got to be watching what's happening in the order flow as we're getting near your targets, right? Either your stop target or your take profit target, right? And how is the market reacting there? How long has the trade been on? Okay, if the trade's been on for an hour and it's just sort of going nowhere, you might want to think about getting out of the trade. Then you got to ask, did the trade get close to the target, then back off? And should you get out early? Active trade management and analysis while in a trade will allow you to make adjustments to your bottom line for the better. All right, so let's take through some trade analysis. All right, so here this blue line is the previous day's high. Okay, so we're coming up towards the previous day's high and we start coming off. Okay, now on the way down there's a layering in. I'm noticing some layering in here with this imbalance here. Okay, I get short. Market starts coming off. It comes off from the 71 area down into the 60s. Okay, then it starts going sideways. So you got your vertical move followed by a horizontal move. Okay, then we're going sideways in here. What's happening now? Is it still bearish? Yeah, I got some negative deltas all lined up here except one small positive delta. Okay, yeah, I would still like to be in this trade. I got a target down here at 65. If I'm short at 71 or 70, that would give me 5 points. But then it just sort of starts ticking its way back up. Okay, now in here I'm seeing layering, bullish layering. Right over here I saw bearish layering. Okay, this one down here I'm not going to count, but when I see this bar right here with the two selling imbalances, that's a bullish layering. Now I've been bearish since 1033. It's now close to 1050, 1045, and I'm seeing some bullish order flow come in. Now it's time to cut it, right? Even though I've got still a take profit down here at 65, I'm still here 2 points away. Okay, well, I had the move, then it just stalled out, went sideways. All right, analyze what's happening in the order flow and get out. Here's another example. Okay, so over here, it's hard to see on this bar. Let me see if I could draw a box around it. Okay, just do in here, color it, take out the color rather. So there's a 5. There's 26, 27, 150, 120. I'm sorry, wrong bar. This is this bar here. It's 12, 46, 59, 111, 190. Okay, so there's my 5, right? Get long. Okay, fine, I get long. Then the market started going up, right? There's another 5 in here, 39, 46, 101, 114, 235. Okay. So I've got 2 5s going on there, right? Okay, so it's bullish, bullish, bullish. Okay, then what else do I get? Right, I get up in here in this area. I got 2 small deltas. Okay, right in here, small delta minus 24, delta of 1. Okay, so now I'm thinking swing low, swing high up here. Okay, is there any negative reason in this trade so far? I've been bullish from here coming up in here, vertical move, horizontal, going sideways. Which way are we going to break out? We're going to break out to the upside or to the downside? Well, we poke up here and then still go sideways. And then we get back-to-back big delta, right? This time it's over here at the high. Right here, back-to-back big delta. Okay, so now this is my sign to get out, right? You go back to the trade entry, the trade setups on the previous module, and you'll understand when you see back-to-back big delta, it's often a sign of the move being over. So I'm long from down here, 44. You get that move all the way up to the new highs, back-to-back big delta. Okay, fine. I could get out of my position up in here around 53. So there, done and dusted. So trade monitoring, as soon as you get into a trade, you want to start seeing the market move in your favor. If it does not, and instead immediately starts moving against you, you probably shouldn't be in the trade. This is the time a trader earns his living, right? This is why what you got to do as a trader, right? You got to manage the trade. You must be alert to quick moves, but you also must be suspicious of what's happening in the market. And what do I mean by suspicious? Well, think about it. Why did you get into a trade? You expect the market to either continue in its current direction or reverse its current direction. You made a trading decision based on current market conditions, but the market is not reacting the way it should. And this could be caused by an underlying change in market conditions. Okay, so ratio and divergence fails. Okay, come back up here. Got another divergence. It's not a ratio, okay, but I got two divergences. I got a third divergence. This time's another divergence and a ratio. Okay, I'm looking for this market to come off. I get short. It starts coming off. Great. But be suspicious, right? If the market starts coming back up, as it does here, takes out the high, I got to be careful because now I got to be asking myself, are we in a trending market? Okay. Now I've got another, this is not a divergence, it's a bearish ratio, 2.0.2619. I've got point of control on the extreme, so another bearish sign. So I just had 1, 2, 3 bearish signs. Market came up, made a new high, and threw another bearish sign, and market starts coming off. Right? It's doing what it's expecting to do, then it starts ticking back up. Right? Got to be suspicious at this point. Why is this market going up? I'm expecting it to go down. I've been expecting it to go down, but it's still showing strength. If it comes back up to that high, I got to turn a buyer. Right? Forget about trying to short it again, because there's some underlying strength in the market that maybe I don't see or something, but I can see that what I'm expecting to happen isn't happening. So that tells me I'm not just off, I'm way off. Right? Now that's not an indictment on me as a trader, but it's telling me, what should happen is not happening. So there's probably something more deeper afoot, right? Because it's not just me that's trying to short it. You can see hit the high, come off, hit the high, come off. So there's other people also hit the high, come off, hit the high, come off. There's other people also trying to short this high, and it's not working. Because why? We're in a trending market, right? This is maybe the longer term money is coming out of the woodwork buying here. So pay attention to what should happen if it doesn't, right? Be suspicious. So monitoring a trade gets tricky for many traders because they want to overanalyze every tick when they don't need to do that, right? What you need to do is monitor the pulse of the market. You don't need to analyze every contract that trades, oh, they bought one here, they sold one here, bought one there. No, the order flow is the pulse of the market. And I talked about this earlier in one of the earlier modules. There are 3 conditions you can find yourself in after getting into a trade, right? It could be easy, right? The market doing exactly what it should, right? Those are the best trades that you can take. Neutral, it's the market spinning its wheels. It's not moving exactly as it should, and based on the order flow, but it's still moving. Okay, it's still going there. Maybe it's grinding a little higher, but it's not moving as fast as you'd like it. That happens. And difficult is you get into the trade, immediately it's against you, comes back to break even, then back against you. You just got to bail out on those, right? Turn mother's picture to the wall and get out. So easy, right? You get short and the market just sells off. Doesn't get any easier than this, right? 50, negative 15, negative 240, negative 1500. Then it just drops from 02 down to 92. Boom. Multiple selling imbalances, multiple selling imbalances. And it just goes, right? It just does what it's supposed to do. That's great. Now the neutral, right, starts going up, goes sideways, then continues going up. Okay, this is that neutral zone, this middle zone, right? It's not a straight movement. It's sort of pausing, catching its breath, and then continuing on. Because where it gets tricky is it can pause, catch its breath, and then go back down, right? In this case, it went up. And the difficult ones, as soon as you get short, as soon as you get long, it just immediately turns around and stops you out, right? You get long. There's a nice delta surge here. You can see the deltas, minus 2,000, minus 1,200, minus 168, plus 141, plus 196, plus 734. Hey, that's great. We're moving along. Selling is getting weaker. Buying is getting stronger. Comes up, wham. The market just comes back in 2 bars later, comes back towards your stop. You got to get out rather than getting stopped out down here. Right? If you get out up here, you can save 2 points. Great. But these are those difficult trades that, often just go right directly to your stop and stop you out. We all love the easy trades, but unfortunately not all trades are easy. Trade management is a form of risk management. So if a trade is in the easy stage, that's good. That's great. That's what you like to see. The market is moving in your favor. You can choose to add to the position. And if a trade is in the neutral stage, you can reduce your position. You can tighten your stop. There's no law that says, oh, you can't reduce your position. You can't tighten your stop. No, you can. You can do that. But still a lot of traders are reluctant to do that. Now, if a trade is in the difficult stage, the market is actually acting unexpectedly, or you have become uncertain of the current market condition, then you just get out of the trade. There'll be other trades. Oftentimes there'll be plenty of trades in a trading day. Sometimes I find myself trading more than I should. I've got a lot of setups I like to look for. I'll usually key in on a handful, but sometimes I can find myself taking a lot of trades in a day, upwards of 20 or 30 trades in a day. Some people will say that's too much, but for me, I feel, hey, that's fine for me, because I'm comfortable with my setups. I'm comfortable with the plans that I have around them. And remember, markets can go from neutral to difficult very quickly, right? They could go from, here, where it's just sort of going neutral in these 2 bars, to difficult very fast in 1 bar. You can see it could just go to difficult right there. So reasons for getting out of a trade early for a loss. Again, people don't like to get out of trades for losses. And to get out of a trade early for a loss is something that a lot of people struggle with. So if the market is not moving in your direction, now it sounds simple, right? Oh, the market's not going in my direction, so I get out. But still, a lot of people will hold on to that position. It's like being in a bad relationship, right? I've been in bad relationships, and sometimes I think back, I say I should have cut that relationship a lot earlier, rather before it got worse. And it's a difficult decision, right, to get out of a trade early for a loss, but it's something that you have to do, right? You have to take the loss, right? You have to cauterize the wound, so to speak. I expect the market to move in my favor sooner rather than later, and it depends on the trade setup as well. So if I'm buying a pullback, I expect a little bit of heat, right? Because I'm buying a pullback. Now, if it's a momentum trade, then the market needs to move sooner rather than later, right? If I'm buying momentum, I expect the market, the next bar, to be up, not down. Okay, and if the trade is against me for a prolonged period of time, it doesn't necessarily have to be like way against me. It could be a few ticks below my entry price. I mean, I've been in trades where I get long at say 56, and the market's trading 54, 53, 55, like that for 10, 15 minutes. It's like, geez, I'm not ever in the money. Okay, at some point I said, just cut it, right? I'll wait for the next opportunity, right? Rather than sit there and say, well, it's only a point below my entry price. Okay, let's give it some more time. It's often, you win about as much as you lose on those, honestly. And I just find it easier for me, for my mental state, to get out, right? So for example, right, this is the one I was talking about earlier. So you got your swing low here. You can think about putting your stop here or even here below this bar, this first green bar with the positive delta. On a delta surge, that's where I would put my stop. And the market comes down, right? Boom. Right? It goes up 2 bars and then retraces back. My stop is right here. And then it just sort of bounces back up to around 41. Now, I got my stop at 39. We're trading 41. I just had a big selling coming in here, right? What do you think I'm going to do? I'm inclined to get out, right? I will get out over here on a bounce at 41 because I know with this strong selling, it can often spill over in the next bar or two, okay? And it takes 3 bars before it breaks down and would have stopped me out. So, getting out early, there's no shame in getting out early unless you overmanage and get out of every trade too early. But, if the order flow is negative, by all means get out. Right? It's got to be strong negative, not like 1 bar. But, I'm staring at this. Oh my God, I got 2 stack selling imbalances. I've got, this stack selling imbalance is 5 levels. This one's 3. I got another imbalance in there. So I'm looking at, was that 9 imbalances in the 1 bar, massive, strong negative delta minus 1600. Yeah, I got to get out, right? That could be, it's not going to take much to push this market a little bit further down. Another reason for getting out of a trade early for a loss is the original trade reasoning is invalidated. So for example, if the reason for the trade was to buy a stacked imbalance, but the market is unable to remain above the imbalance, you get out, period. Right? If you short because of a bearish prominent point of control that you think is resistance and the market rallies up to and above the prominent point of control, you get out. Order flow gives you very precise reasons for being in a trade. As a result, if the trade is not working as expected, get out, because those reasons based on the order flow, if they're invalidated, then the order flow has changed, period. So for example, right, you're getting long. Oh, okay, I got my nice stack buying imbalance. I'm going to get long here. Okay, then it just goes 1, 2, 3, 4 bars. You're expecting the market to move. Where is the aggressive buying coming in to support this stacked imbalance? It's not there. Instead, you're seeing selling imbalances in that area. That's not a good sign. Okay, you get out, period. So another reason for getting out of a trade early for a loss, when I say early, in this case, I don't mean time-wise. I mean, early before it goes to your stop level is time decay. The longer you're in a trade that's not going in your favor, it could be in the neutral stage. The reason for taking the trade is wearing off. Right? Many traders will remain in a trade that is not paying them in hopes of eventually working out. It's like getting married to somebody who's an awful cook. Right? And you got to eat their food. Right? You don't necessarily want to do that. Right? So, maybe you want to cut your loss on that. I don't want to say get married and divorce someone because of the food, but maybe you're dating somebody that only knows how to cook instant noodles or something. You got to be thinking, do I want to be spending the rest of my life with a person like this, or somebody that wears a ton of makeup, right? They take it off, they're a completely different person. It's it's not, the reason for getting into the relationship is no longer valid, right? Just as being in the trade is no longer valid. So for example, right, you're getting short in here, right? You got your stack selling imbalance off the high. Great. Get short. Hey, it's going in my favor. Then it's just hanging around the entry price 1, 2, 3, 4 bars. Right? This is a secret, not a secret, but this is one of the reasons why, I tell people this, one of the reasons why I draw these stacked imbalance zones out at a certain level is because this is the decay. I'm looking for that movement within this zone. So if 1, 2, 3, 4 bars, we're still trading in there, that's not a good sign, right? You can see here, markets move up, right? We're well above the zone, the imbalance zone. That's what you want to see. If we're just hanging around it, that's your sign to get out. The trade's not working as expected. Now, just about every trading method or strategy is concerned only with entry and exit, but not with what happens in between the entry and exit, where things can continue as expected, or do nothing, or change drastically. Right? Most traders think of risk only in terms of money, but there's a time risk as well. Time risk is a self-imposed risk by the trader in the form of active trade management. So, for example, right, at some point, a trade has to start working. It has to start going in your favor. Right? Here's a nice stacked buying imbalance. You buy it. Okay, it starts going up, then it comes back down, and it's still going inside that area. It's just sort of grinding higher. Yeah, can it go up? Yeah, maybe. Can it go down? Yeah, very easily. So your bullish reasoning for buying here all of a sudden is no longer there. Instead, this is the trap that a lot of traders fall into. Well, I'm getting long here at 56, okay, and it's going up 58. Yeah, that's great. Maybe they got to take profit up here at 60 just for the high. And then the selling comes in here, right? And you're back down at your entry price. They'll say, well, you know what? I'm still in the money. I'm going to let it go. And then often, now things are changing in the order flow. With this bar, everything changed. You're seeing stack selling and balance, and it starts coming up, right? You see some layering in here, even though this is a doji bar, and the market keeps going up, and they're thinking, okay, yeah, I'll stick with it, right? Even though there was a negative bar in here. Then it gets into this area up in here, right? More layering coming in. This time it's bearish layering, right? Here, potentially here. Okay, but they're like, well, I'm still in the money. Okay, at this point, your original reason for being in the trade is gone. It's long gone, right? You sort of had a new one coming in here, but then you got another one here, an opposite one coming in. So, if you're stuck in a trade from, 20 minutes ago, but then you're starting to see other signals coming in, bullish or bearish, you got to disregard this already and sort of treat it as a new position, in the sense that, okay, well, where are we? Okay, I've got a position on from 56. What's happening in the order flow? Forget about, I had this nice stack buying imbalance here. At this point, that stack buying imbalance is in the rearview mirror. I wouldn't even consider it in my analysis. Okay, I got to be looking, do I still want to be in it? Yeah, I see some layering in here, but then you get up here, I see layering in to the downside. Okay, so fine, I'll get out. I got a point. Fantastic. Be happy with that point. So every trade that you enter into has life cycles. Okay, from the moment you enter into a trade to the moment you exit the trade, conditions are constantly changing, either in your favor or against you. The longer you're in a trade, the higher the chance of something that can happen that can change the market condition. Right? Time is a risk factor. The life cycle of a trade is imposed either by the trader or the market. Now, if you struggle getting out of bad trades, run through a mental checklist of the pros and cons of remaining in the trade. Are there more pros than cons? Then stay in the trade. If there are more cons than pros, then just get out. Remember, there's always going to be trading opportunities in a trading day. I swear, people sometimes, they don't understand how many trading opportunities there really are in a day. Now, it's good exercise you can try. If you don't think there's a lot of trading opportunities in a day, take the chart you're looking at, cut it in half. If you're looking at a 1 minute chart, look at a 30-second chart. Okay, if you're trading bonds, forget about it. But if you're trading E-minis or crude, go to a 30-second chart. You're going to see a lot more trading opportunities. You'd be amazed at the amount of trading opportunities that appear on a 30-second chart. Now, I don't recommend that for everybody, but I'm just saying, just take a look and you'll notice how many more trading opportunities there are. All right, so when managing the risk of time, a trader must be monitoring the current market situation and ask, is the order flow continuing in the direction of the reason for getting into the trade? Has the order flow changed direction? It's gone neutral? Has it gone from bullish to bearish? Has it gone from bearish to bullish? Is the market doing what is expected, or is it behaving differently? Right? You got to run through that checklist in your head, right? If you're struggling being in a trade, right? Most important is, what is the order flow telling you? Has it changed direction, or is it still neutral? Is it bullish to bearish or bearish to bullish? Okay. So how does a trader consider the time risk of a trade? For example, right, you buy crude oil expecting the market to go 50 cents higher. Over the next hour, crude only goes 15 cents higher and then goes sideways. You were looking for a 50-cent move, but you only got 15 cents. I mean, didn't get 15 cents, only moved 15 cents, and it's just kind of stabilized there. It's not going higher, it's not going lower. What do? Do you get out and book the 15 cents, or do you move your stop up to break even and just let the trade continue one way or another? These are questions you got to be asking. What's happening in the order flow? And if the order flow is not still bullish, then you get out. If it's kind of neutral, I'm more inclined to get out at a profit because, well, what's happened? It's gone from bullish, now it's just gone down to neutral. Can it go back up? Yeah, it can, but can it go down? Yes, it can. Do you want to expose yourself to that risk of breaking even on a trade when it's been in the money for quite a while? Now, traders often get around the time factor by using charts that remove time from the trading equation, so to speak, and essentially eliminate the time risk by using range-based charts, volume and tick-based charts, and there's a few other types of charts you can use. So is that good or bad? The answer is it depends. Okay, it depends on you. There's no one perfect chart, but there's a chart that suits you and your trading style, right? You have to look for it. You have to go through different charts. I don't want to say chart books, but you got to look at different charts and find the one that suits your trading style. So for example, range-based charts, right? Range-based charts based on price movements. This is an 8-range chart. I'm very comfortable on an 8-range chart, on a 4-range chart. Okay, I'm very comfortable on range-based charts. Volume-based charts is something that a lot of traders also use. And again, this comes down to what you're comfortable with, right? You can see, there's no fixed time factor. It's based on the volume traded. Oh, this one's a tick-based chart actually, but it's based on the amount of ticks in the chart. Okay, this is the volume chart. I got them backwards. This is a tick-based chart. Yeah, I don't want to leave it there. Based on the trades in a bar, right? Not the volume, the amount of trades. One trade is one tick. Okay, tick. This is a volume-based chart, so it's based on volume. So you'll notice, right, on the amount of volume in a bar. So you see, it's 1,000 volume right here. It says 1,000 volume. The volume in each bar is 1,000, whereas on a tick, even though it's a 500 tick chart, some bars are 567, some are 652, some are 601, because it's measuring each buy and each sell, the individual ticks in there, right? Each trade is a tick. So that's how some people get around, and sort of filter out, in a sense, the time in the market by using volume-based charts, tick-based charts, or range-based charts. Okay. Personally, I like range-based charts. I use time-based charts. I use range-based charts. Range-based, I like to see how the markets move, right? As opposed to the volume. I mean, I'm already looking at the order flow, so I can get a good sense on the volume. But that doesn't mean you can't use volume-based charts on order flow. There are people that are very successful using volume-based charts with order flow. Okay, because they're looking for pockets of volume, basically. And when signs in the order flow confirm it, it's go time. So which chart to use for you? It's a personal choice based on your risk tolerance. There's no perfect chart, but there is a perfect chart for you, right? It's not, in trading, nothing is one size fits all. I often get a lot of questions. What chart should I use? Well, you got to tell me more about your trading. We go from there. If you can't sit through a trade for 3 minutes, then trading a 1-minute chart is probably not for you. Trading a range-based chart is probably not for you. If you're someone that's just looking for a few ticks, then we're going to use like a 4-range chart or something that moves very fast. So it really depends on your trading style and your risk tolerance. Can you sit through losing periods or not? Now, the last type of risk I want to talk about is event risk. And event risk is something that's out of the control of you, right? It's out of the control of the trader in terms of risk, but a trader must still be aware of it and protect himself from it. You protect yourself from it by having a stop in the market. And you can't plan for it in the sense of, I'm going to build it into my trading plan. You can plan for it by having a stop in the market. For example, right, outside of the markets, right, in soccer, right, in football, it can suddenly rain, which is going to change the footing on the pitch. So you don't have control over that. You don't have control over the weather when you're playing soccer. And trading systems generally don't take into account event risk because they're built on large data sets of data occurrences, and they're not taking into account the event risk. Now, there is an actual one that you guys sort of went through recently in 2020, and what that is when the exchanges raised the margins, right? The margins were raised at the exchange level, then obviously the brokers got to follow suit, and especially the ones that offer day trading margin, is all of a sudden people couldn't trade mini S&Ps at margins of $50. They got to be fully margined, which is what, $12,000 to trade an E-mini. So in some cases, traders were forced to liquidate positions they just couldn't afford anymore. Okay, because all of a sudden now, their account is, whatever, $10,000. They can't even trade on one lot. Okay, so now they're on the sidelines. And if you were, because before the coronavirus hit, the intraday margins, I believe, were around, I'm trying to remember exactly what they were, but they're around $6,000 or something like that. Okay, and imagine you have $20,000 account, all right, and you've got two lots on. Okay, you think you're safe, but then all of a sudden they just double the margins to 11,000. Well, you can't hold two contracts; you can only hold one. That's something that's out of your control. Now, if you're trading intraday, obviously you can't trade. If you got a $10,000 account, and all of a sudden they're charging you the initial margin, you can't trade it because you don't have enough money in your account. So that's something that's out of your control. So, in the back of your head, you got to keep it in your mind. But again, it's something I wouldn't worry about until it comes. Now, if you're trading during the day, right, and there's always going to be something that happens every once in a while. Trump tweets or something. That's event risk, so to speak. You don't know what he's going to say, right? He's an unstable genius. That's his famous line. He's a stable genius. But if he puts something out like, oh boy, these Chinese, what are they up to? Everyone's going to read that tweet and go, oh my gosh, the trade deal fell through and the market's going to drop off. That's event risk. That's why you got to have a stop in the market. Now, something you got to think about, okay, is what is more important, a trading method or trading psychology? Because again, earlier when I started this module, a lot of traders feel that risk management is the most important part of trading, right? Then there's also people that say, well, no, the trader psychology is the most important thing, right? Because if you don't have the psychology to be a good trader, it doesn't matter what your trading method is because you can't handle it. But I think both of those sayings, risk management being most important and psychology being most important, it's perpetrated by traders who don't have a profitable trading method. Traders that aren't very good at trading. Because think about it, right? If you're a good trader, if you're a profitable trader, doesn't that give you a psychological edge over other traders, right? You don't have to worry about, I don't have the right psychology to make it up, or I don't have the right risk management. No, you do, right? That's why you're successful. So, it's a bit of reverse psychology. Now, I'm getting ready to wrap it up, but there's a few miscellaneous things I just want to cover. I just sort of, I don't want to say like loose ends, but these are things that you have to be aware of, right? Now, you often hear people talking about discipline, okay? More often than not, people that talk about discipline have never traded day in and day out on a regular basis, right? Telling a trader that they have to be more disciplined, quote unquote, just shows that the person saying it probably hasn't traded, right? The market is mean, right? The market is cruel, and if you're not disciplined, it will crush you. But the thing is, you need to develop discipline, right? You can't just say, oh, okay, I'm going to be more disciplined. No, you got to develop it, right? It's not like a light switch. You can just turn it on and off. That's why, people that just flippantly say, oh, you need to be more disciplined. Well, no kidding, right? I mean, that's obvious. But, for someone to say that, I don't think they understand trading in the sense of being in the grind day in and day out. No kidding, right? It's like very early on in my career, I made a few trading errors, and my boss is like, just don't make errors, period. Simple. Fix it. All right. But anyway, think of it like learning to drive a car, right? We all want to go fast, right? But once we start driving, right, there are times that we go above the speed limit, but we know the times to exert discipline, right, to keep us safe. So it's not we're all going to drive at 100 miles an hour. No, we know, on a flat straightaway in the middle of Iowa, yeah, maybe I could, exceed the speed limit. But, if I'm driving on a windy road and it's raining, I'm not going to be driving at that. We have the discipline to keep ourselves safe, just as eventually you'll get the discipline in trading. Now, there's differences in market activity. Again, trend days up and trend days down. Okay, and I just want you to realize this. On trend days up, I find markets react less from an intraday high than it does from in the lows on a trend day down. On trend day downs, I find markets often have bigger reactions from the lows. So give the position a little bit more room. Okay, just bear with it, because it's easier for people to buy when something is at its lows. Okay, it's not necessarily easy for people to sell when we're at the high prices. So, just bear with that. If you're short and you start bouncing up, just, think about it. Think about your position. Now, when trading inside the day's range, to maximize your trade, you should look for areas where the market can go to. Areas where the market may run into support and resistance, right? Most traders have a take profit and stop loss. But if your take profit is beyond an area where the market may not get to, then you have to understand that and adjust accordingly, right? This is the problem I have, going back to, people that say, well, I have my stop loss and my take profit is fixed at these levels. Well, okay, but what if the market starts getting up to, sometimes their take profit, I'll look at it and, based on, simple looking at the chart, it's impossible for the market to get there, right? You got to make new highs and break through, a bunch of resting liquidity to get there. It's probably not going to happen, right? So you got to look for areas where the market can trade to, okay? So you got to take into account market structure, okay? Because I said, if your take profit is just beyond an area where the market's going to have a hell of a time getting to, then it's probably not going to get there. And to be honest, if it's just behind an area that's the market's going to have a hell of a time getting to, chances are you probably want to move your take profit to a higher level, because if we get through that area, it could be go time. It could make that big move in a direction. So lastly, why do you get into a trade to begin with, right? It's because you have seen some kind of pattern developed in the market that you have seen before and traded profitably. But what happens when you get into a trade and the market just goes against you from the onset? Ask yourself, are you just going to let it stop you out, or are you going to bail out of the trade early because you recognize it's a lost cause? Think of chess. Okay, the best way to think of it is, chess master can tell long before the game ends if he's going to win or lose. Right? You have to sort of get to that point in your trading where you could look at the chart, look at the footprint, say, yeah, we're going to go, this is going to be a winning trade, or this trade is not working out. I got to seriously reconsider and come up with a different strategy, or a strategy to mitigate my risk. Think of it in that sense, right? There's some I don't want to, I like to read. I'm a very eclectic reader, right? I like to read books on a wide variety of topics, but I like reading biographies of chess masters, because it talks about sort of their thinking, okay, and you really got to apply it to trading, and you can also read books on poker, right? There's a lot of the same strategies involved in poker that can be applied in terms of psychology, in terms of risk management, and in terms of playing a hand, just like playing a trade, watching the trade develop, how to get it, how to stay in longer, or how to just say, fold. So anyway, we are coming towards the end. This concludes module 10. In module 11, I'm going to discuss how to use order flow to let winners run. And I wanted to put this as a separate chapter because letting winning trades run is easier said than done. Everyone says, "Oh, you gotta let your winners run." Well, how? All right. At the same time, they tell you, well, you got to have a risk to reward ratio of this. Well, if I know my risk to reward ratio is this, my winning trades will never run because my take profit is fixed. So anyway, in the next chapter, I'm going to discuss that. So I'll see you all on the next module. Bye-bye.